Hey everyone, welcome back to Corporate Dakota today. Carlyle AlpInvest Private Markets. Secondaries Fund just filed its latest prospectus amendment, and I'm seeing some very interesting details on investment strategies and associated risks. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing really lays out how deep and complex private market investing can get and who really bears the brunt of the risk. So this document is a prospectus. It is basically an informational brochure for potential investors in the Carlyle AlpInvest Private Markets Secondaries Fund. The whole point of this fund is to invest in private markets, which means things that aren't publicly traded on a stock exchange, like stocks or bonds, often bought and sold through private deals. Their main goal is to make money grow over a long period of time by investing in these private markets. They'll invest in private companies and funds all over the world. They plan to put at least 80% of their money into something called secondary investments. Secondary investments basically means they are buying existing stakes in private funds from people who already own them. It's like buying a used car, but for investment funds. They can also buy into brand new funds directly. This is called primary investments. Now, this is where it gets really important. Any investment has risks, but in private markets, these risks can be even bigger. This fund is pretty new, so they don't have a long track record to show how well they've done. This means you can't just sell your shares whenever you want like you can with public stocks. You might have to hold on to it for a very long time. You can only get your money out if the fund decides to buy your shares back, and they don't have to do it. This is a big one for people buying Class U or Class D shares. There is a sales charge up to 3%, so you need to make more than 3% just to break even on that charge. They're saying this is a risky investment, especially because they might borrow money to invest more. This is called leverage, and it magnifies both gains and losses. This is standard language, but it means the government isn't telling you it's a good investment, just that the paperwork is in order. Here they are showing the price for different types of shares. Class U and Class D have a sales load, but Class I doesn't. See, when I talked about that sales load, Class U and D have up to a 3% load class. iShares are free of that load. This is the money that actually goes into the fund after sales loads are taken out. They hope to raise up to $1.88 billion into the fund itself. TCG Capital Markets is the company that sells these shares, but they are doing it on a best efforts basis, meaning they'll try their best, but don't guarantee they'll sell it all. Getting started requires a lot of money for Class U and Class I shares. You need at least $25,000 for Class D shares. It's a whopping $10 million, though they can lower that for some people. This is good news. They've agreed to limit the operating expenses to around 3% in the first 18 months. This means more of your money stays invested. Again, they highlight that this is a new fund with no public trading history for its shares. This means you can easily sell them. The fund is structured as a special type of company called a closed-end management investment company. It is also not diversified, meaning it can put a lot of money into just a few investments, which increases risk. They reorganized an older fund into this new one to start things off. The actual manager of the fund is AlpInvest Private Equity Investment Management, and they are part of the big Carlyle group. You can only invest in this fund if you are a qualified client. This usually means you have a lot of money or a high income. This whole document is meant to tell you everything you need to know before you put your money in. Okay, so far we know this is a very high risk, high minimum investment in private markets. You can't easily sell it, and you need a lot of money to get in. Looking at the fees again, Class U and Class D shares have that 3% sales load at the start. And here is another big one. If you sell your shares back to the fund within the first year, they charge you an extra 2% fee. This is to discourage people from pulling their money out too quickly. The yearly management fee to actually run the fund is 1.25% of the money invested. This is pretty standard for this kind of fund. They also expect to pay about 0.75% in fees for the other funds they invest. In this is money going to those underlying funds. And then there are other general operating costs. Class I shares have the lowest of these expenses, and they have a plan to limit these in the first year. This is the part I mentioned earlier. They are waiving some fees for the first 18 months to keep the total expenses lower. So after all the fee waivers, Class U shares will have expenses of about 3.6%, Class D will be 3%, and Class I will be the lowest at 2.75%. These are still pretty high total expenses. Let's look at what these fees mean for a real investment for a $1,000 investment, assuming a 5% annual return over 10 years. For Class U shares, you would pay about $65 in fees in the first year. For Class D shares, that drops to $59. And for Class I shares, it is only $28. You can see how those different fee structures really add up. They spend a lot of time talking about the risks. One big risk is called illiquidity of fund investments. This means it can be really hard to sell these private investments quickly. They hammer home that you can lose all your money investing in private markets is inherently risky. There are a lot of other big players trying to invest in these private deals. So sometimes there just isn't enough good stuff to go around. They can borrow money to invest more, which, as we said, makes things riskier. They might also invest some money in bonds which have their own risks like interest rate changes. And if the issuer can pay you back, global events like wars or economic crises can really mess with their investments. This is super relevant today with all the global tension. This is interesting. They mention the risk of using artificial intelligence AI. They note that AI relies on data and algorithms. And if that data is flawed, the whole system can be wrong. There are rules in place to make it harder for someone to buy out the whole fund. This means current management has a lot of control. The sale of shares is on a best efforts basis, meaning the distributor isn't guaranteed to sell it all. If they don't sell much, it means less money for investments, which can hurt returns. They have special permission from the CC to offer these different share classes, which all have different fees. This is a crucial point. They invest in a lot of private assets that don't have a clear market price valuing these things is subjective and can be very different from what they actually sell for. Remember, I said you can't easily sell your shares. This is how you might be able to get your money out. The fund may offer to buy back shares from time to time, but it is totally up to them. They expect to start buying back shares about a year after they begin operations, and they plan to buy back up to about 5% of the fund each quarter. But this is not guaranteed. If you try to sell back shares within the first year, they hit you with that 2% early repurchase fee again. When you sell shares and get money back, the government wants to know the cost basis. So you pay taxes correctly, they will report this to you. They want to be a regulated investment company, or RIC. This is a tax status that means they generally don't pay corporate taxes if they pass most of their earnings to investors. They have other funds managed by Carlyle and AlpInvest, so there is a risk that investment opportunities might be offered to those other funds instead of this one. It is hard to maintain that RIC status. They need to follow strict rules about what they invest in and how much income they distribute. Okay, so the big takeaway here is that this is a fund for very wealthy individuals or institutions who can afford to tie up a lot of money for a long time and who can stomach significant risk. They are paying high fees for access to private markets. And there is no guarantee they will get their money back easily or quickly. The biggest risks here are lack of liquidity, high fees, and the inherent complexity and uncertainty of private market investing. It is not for the faint of heart or the average investor. That is my take. These filings are key to understanding what companies are up to, and the research tools I actually use are linked in the description. They help keep this channel going. Hit like and subscribe for more decoded corporate filings. Leave your thoughts in the comments below.